right, stocks taking a rare breather yesterday. They were pressured by weakening U.S. bond prices. Let's bring in Sean O'Hara. He's the president at Pacer ETFs. Sean, good morning.
Good morning. I'm trying to get the image of Vladimir Putin out of my head.
Yeah, don't worry. Well, we'll show you another image. Let's show you the chart of the yield on the 10-year Treasury yesterday. It hit 2.6%. This was the highest level since, well, September of 2014. What do you make of that?
I'm not really particularly worried about it. I think the bond guys need to realize that the bull market in bonds is over. And, 10, 15 basis points on the long end is not necessarily a bad thing. We had the Apple announcement yesterday that said that they were going to invest $350 billion in the U.S. And I was trying to put that in context. After the financial crisis, we had a major stimulus, although those who studied at the IB Institute would tell you can't get stimulus from government money. But Apple and their $350 billion amounts to about 35% of that $1 trillion stimulus bill. And this is true stimulus. So I think we can take up some of that slack. What I'm more worried about on bond rates are two things. I don't want the yield curve to invert. So I'd like to see it drift up a little bit. And then the other worry, perhaps, with regard to yields is if U.S. Treasuries go up too much, it'll make them attractive, and we'll see foreign buyers buying those bonds, and that'll drive the dollar up. The dollar has been weak here lately, and that's been a massive tailwind for equities in U.S. companies. The
dollar was down 10% last year, down this year, too. And if you look at equities and this rise, are you concerned that this is a bull market that knows no bounds?
Well, no bull market knows no bounds. So we're 9 years in. The environment looks good. The old adage is that, Noah started to build the ark before it rained. So I think you need to start thinking about what it looks like if we have a reversal and putting plans in place. But when you look at all the things, we could have 3%, under 3% unemployment, over 3% GDP, and it would be okay with the 10-year Treasury around 3. Those 3% numbers are significant. And if that comes true, if we could even have 4% on GDP growth. So all that bodes well for the equity markets. Right. They are a little pricey, but I think we're going to see a surprise on earnings coming up in the first quarter of this year that perhaps could get things back into a more normalized range.
Interesting. Quickly, because I do want to get to Bitcoin, but what sectors are you avoiding right now?
It's easier for me to talk about where we're allocating money based on our cash flow models. Financials, industrials have popped up here, energy's popped up here, and technology continues to be. I think utilities and consumer staples are the two areas of the sectors of the market where there's perhaps a little room for some concern, only because they got bid up so much because investors were looking for yield. Mm-hmm. Utilities really aren't growth investments. They're kind of bound by how much they can raise utility prices and the growth in a particular market. And I've heard recently that some of the utility companies are going to lower energy prices as a result of the tax bill. So I'm not a big fan of utilities right now.
All right. Sean O'Hara, thank you so much for coming on. Have a good weekend.
Thank you.